Gareth Isaac, the yield on the 10-year Treasury bond is now solidly back above 2%. So was the 1.7% yield we saw back in January the low for the year?
Yes, I suspect it was. I think one of the main driving factors behind US Treasuries have been the low level of yields within Europe. US Treasuries have been driven down because bunds were at 5 basis points. That's started to unwind now with bunds rising. So I don't think we're likely to see yields falling to the level that they've seen in the first half of the year.
All right, now talk about the economy, because clearly the yield in the 10-year has some relation to what's going on in the economy. We had a bad GDP report. A lot of people threw out what happened in the first quarter due to bad weather. Tell me your view of the state of the U.S. economy.
Well, we're relatively positive on the U.S. economy. The first Q1 data was very weak, whether it's something to do with the ports, as you sort of suggested, or whether it's something to do with seasonality, or even the weather that you had here in New York, which was pretty bad. The data we're seeing for Q2 is an improvement. The non-manufacturing data was pretty strong, pointing to a recovery in the service side of the economy, and that's what the Fed will really be looking at.
Well, if people are going to head to the exits or rush to the exits with regard to their bonds, how quickly can this spiral out of control? Because that's the big fear out there, is people are just going to sell their entire bond portfolio, yields are going to skyrocket, and we're going to have some problems in the market.
Well, we're starting to see that in Europe. I mean, the moves in the long end of Europe have been pretty ferocious over the last few days. It's a very well held position and held by non-natural owners of those particular types of assets. Many investors that have been invested in fixed income are being quite used to falling yields and capital appreciation. If that does start to unwind, I think that they may look to other investments with slightly less risk in them.
Well, you own some European bonds in the Schroder Strategic Bond Fund. Talk about your sovereign positions.
Yeah, I mean, we have some exposure to periphery, but not a great deal. And a lot of it is hedged, duration hedged with Germany. I do think that we're going to see more pressure on sovereign yields in Europe as the growth outlook there continues to improve.
Are there countries that you like? Tell me who you like.
Over the medium term, I like countries like Spain. Greece is still in a very difficult position. Their bond that they issued at 5% is now trading in the high teens. That probably wasn't a good investment at the time. We didn't participate in that. So there are some elements of value, but I do think that the positioning in the market means we're going to see a further washout.
And about 20% of that fund is in corporates. How do you choose the right corporate bond nowadays?
Well, rigorous credit analysis. I mean, we like the long end of the US corporate bond market. And we do have a big allocation to that. And the reason is we think pension funds will begin to buy long-dated US assets. And when you think the Fed own 40–45% of all long-dated treasuries, there's a scarcity value in the market. So we still think that that particular area of the corporate market will improve.
That's the part of the yield curve. What about the sector? Which companies or parts of the market are you buying?
Well, we still quite like financials. As the economy improves, we think they'll do quite well. And some energy-related companies as well that have got beaten up, we still think they hold some value.
All right, well, thanks a lot for coming on.
You're welcome.
Thank you for watching The Street.